As we continue to talk about this rally, Josh Brown, Shannon Sakosha, Jim Leventhal, and Steve Weiss joining us. Let's first check the markets as we always do. We're higher across the board today. The S&P 500 and the NASDAQ each hitting new 52-week highs. As you see there, yields, they're down. The 10-year note yield is at 3.79. So, Josh, I'm going to begin with you. The rally goes on. That's the headline, of course. And how about this headline from Goldman Sachs today, because I think this sums everything up and where I really want to start the show. For the first time in 23, we're currently being asked by multiple clients if we think the S&P 500 is now on track to close at an all-time high before year-end. Quote, I'm going with a yes on this. Wow. Are you going with a yes on that, too?
I mean, I hope it does. I don't know precisely, whether or not it'll close up, down, or indifferent relative to the old high, of course. But I would just point out the most important factor going forward from this point would be increased participation. And we're getting it. And so by that, I mean, I don't think the Magnificent Seven can carry us to a new high if the rest of the market is not cooperating. On a year-to-date basis, Judge, only 29% of stocks in the S&P 500 are beating the overall index. That is the lowest reading that we've had since 1998. That's got to change, and things are in motion that tell me it could change to the upside. But until we get to that point, it's tough to feel particularly confident that we're going to, max out across the board and get that all-time high. I think if you go back and you look at some of the best rallies ever, what most of them have in common is that it started with large cap leadership and ultimately it broadened out. And that broadening out is how you get the multi-year rally that we're looking for. Not just let's go back and kiss the old all-time high from January 22 and then fade away. So the good news is you are starting to get that participation. You're also getting a couple of other things. An end in sight to the rate hikes, a U.S. dollar that's almost 15% off its September 22 highs. That's definitely helping out not only on price, but also on the earnings front. And you continue to get economic surprises to the upside. So that's where we are right now. Things, of course, could change. But if you ask me, gun to my head, is the new high going to happen? I'm going to say yes also, but I'm qualifying it. I need the rest of the market to continue to catch up to what we've seen in the first half.
I hear you. Makes sense. Shannon, that makes sense to you? And the question is, sure, do we need it? Yeah. Will we get it? Ultimately, it comes down to that. What's the answer?
Well, I think one of the things that's driven a lot of the activity that we've seen, and we talked about this a little bit earlier in the week, is just the amount of money that has come out of short covering. And I think we're seeing that, on a week-over-week basis, continuing to see short covering. There will be an end in sight to that. There's a diminishing marginal utility, if you will, in terms of short covering on the index at large. But then there's this question, Scott, of all of this money that's on the sidelines in money market funds as well. And I think we've talked a lot about that over the course of the last year in terms of moving that money from money market funds out in duration in bonds on the curve. But what if that actually starts to fuel back into equities? What if this improved economic outlook? We saw PPI today coming in later than expected, which wasn't too much of a surprise. But what if this improved economic outlook actually leads people back into stocks? And I question where they will go, right? Are they going back into active strategies? Are they going into indexing? Because once again, that's kind of the easy play to go right back into an index. But I agree with Josh in that the Magnificent Seven cannot continue to drive this market. The multiples, I believe, are too high, and that earnings will have to really blow it out of the water to justify those. This broadening out not only in large caps, but in other caps, down to small caps, really needs to occur if you're going to get more of that money out of the sidelines and into stocks rather than into longer duration fixed income.